Okay, I think we'll get started. Just wanted to say welcome and thank you for joining us for our Q2 2021 Wealth Management Call. I'm Susan Martori Baker, President of Cambridge Trust, New Hampshire, and I'm pleased to be your moderator this afternoon for our discussion. Today, you'll hear from some of our senior leadership in wealth management who will provide a global economic update along with their insights on the equity and fixed income markets. Senior Vice President Ryan Hanna is Director of Equities at Cambridge Trust, and he'll provide us with an equity market update. Interest rates and inflation are certainly topics of interest, so we'll hear from our Director of Fixed Income, Senior Vice President Eric Jusson. Dave Lynch, our Chief Investment Officer, will conclude the investment discussion with an economic update. Daily, we're hearing about possible changes to tax laws, including capital gains rate and income tax increases. David Strong, Senior Vice President and Director of Relationship Management, is going to boil down the various bills that have been introduced. Remember that this presentation will be recorded, so if you miss anything or want to hear it again, you'll have the opportunity to do that. After the presentations, the speakers will address questions that you've typed in for them. So with that, Ryan, take us through your equity market update.
Okay. Thank you, everyone. What a difference a year makes. I think our first call was 12 months ago. The world was a completely different place. So happy to be here with everybody today. I'm going to run through a handful of slides and then have a couple of concluding remarks before handing it off to Eric. This is a 15-year chart of the S&P 500, and I just wanted to make a couple of takeaways from this chart. If you look back on the left-hand side of the chart, back to 07, 08, 09, during the global financial crisis, market corrected about 55%. And then subsequently, it took about 6 years to recover the old price levels that we saw in 2007. If you look on the right-hand side of the chart, in 2020, we had a 33% correction in just over 1 month, and it took less than 6 months to fully recover the price levels that we saw pre-COVID. From the bottom, the stock market is up 88% off of the lows, so quite a substantial and significant rebound. On the next slide, these are earnings per share estimates for the S&P 500. The white line is current year, 2021. The green line is 2022. The yellow line is 2023. Similarly, I just want to make the comparison that we've now seen a full earnings rebound, and earnings per share have now surpassed the levels we saw back in early 2020. We're seeing very positive earnings revisions. So from the beginning of this year, earnings revisions have increased almost 12%. So we started the year at about $160, and you can see in the white, we're currently at $184. So we're seeing very positive earnings momentum in the stock market today. Next slide talks a little bit about valuations, and this is something that people are concerned about. This goes back a little over 30 years. The yellow line in the middle is the average forward estimate for earnings, the price to earnings ratio for the S&P 500. You can see that's about 14.5 times earnings. Currently, we're at about 22.5 times earnings. So we're about 1 full standard deviation above average. Clearly, the market is reflecting very positive news in terms of stimulus and other factors. Next slide. I think it's important to recognize that prices and earnings go hand in hand. So this green line is the S&P 500 over the last decade. I've overlaid earnings per share for the S&P 500 on top of that. And you can see there's a very tight correlation between earnings and stock prices. We believe that earnings will drive stock prices. The one dislocation that we did see is in 2018, and that was due to the the reduction in corporate tax rates. We saw a very strong increase in earnings per share, but the market actually was flat in 2018. So that caused that dislocation. But over a long period of time, earnings and prices are highly correlated. Next slide. just to give you some context in terms of returns by style, because there is a lot of dialogue about growth and value and cyclicals and large caps and other things. So I thought this slide would be helpful to explain some of those differences. If we start in the top right-hand quadrant, year to date, and I'll talk to the top line only for this presentation. So large cap growth stocks year to date are up 4.5%. Large cap value stocks are up 18%. So year to date, clearly there's been a bias towards value stocks. If you look below that, since the market low in March of 2020, large cap growth and large cap value are up about the same, 93%. So not a lot of difference, but timing matters. In the bottom left-hand column, growth stocks from the February 20, so pre-COVID, up 32% versus large value up 20. And then over the last 10 years in the top left, you can see the difference. Large cap growth has outperformed large cap value over the last 10 years. So just to provide a little bit of framework, large cap growth is underperformed year to date, but over a longer period of time has done better than value. We may see more normalization in terms of some of those return discrepancies, but that's how the last 10 years has played out. On the next slide, again, just a little bit more context to the reopening trade. The gray line would be 2019 up until November 6th. November 6th was the Friday following Election Day, and it was also the day of the announcement of positive vaccine release data. So prior to that announcement, energy stocks were down 60%, airlines were down 50%. And on the very bottom, you can see online retail was up about 70%. From that positive vaccine release data, we've seen pretty much a 180. So energy stocks down 50 or 60 have gone up almost 90% year to date. Airlines have rebounded very strongly, despite the fact that we're still about 25% below in terms of the number of passengers flying. So this just provides a little bit of context in terms of what's helped and what's hurt, what's done well and what's not done well pre and post vaccine announcement. My next slide talks similar in terms of what that slide we just referenced. If you look at the bottom two lines, so the purple line would be seated dinners, fell 100% in March of 2020 and has recovered to down 22%. So we're making up ground there. And TSA traveler traffic is the light blue line there at the bottom. That too has rebounded, but remains about 36% below pre-pandemic levels. Next slide. I want to mention one risk that we really haven't talked about, but is out there in sort of the domain, corporate tax rates, the hike in corporate tax rates. So if the current administration is successful in raising corporate tax rates to 28%, there will be a roughly 5 to 10% headwind from higher corporate tax rates. So you can see that the 10 or 11 sectors here broken out. Communication services and technology would be the most heavily impacted, where materials and energy would probably be the least. So those are my slides. I have a few sort of summary comments. Markets have been pretty resilient in the early part of 21, fueled by strong rebound in corporate earnings, stimulus, the reopening trade, which is likely to gain some steam in the second half. But valuations are extended and reflect much of the good news. The American economy has surpassed pre-recession levels of corporate earnings and gross domestic product. And we've definitely seen a rotation away from the COVID winners of last year into more value and cyclical oriented sectors like financials, industrials, material, and energy. A few final considerations to note. Don't fight the Fed. If the Fed remains on the sidelines, even in the face of rising inflation, that's likely supportive of equity prices in the near term. Breadth has widened out, so the number of stocks doing better is greater, and it's not just the top 5 stocks performing well. Fund flows into cyclicals have gotten a little bit aggressive, so we'll probably see a period of digestion here. The dollar has weakened, which is positive for commodities and energy. The consensus is that inflation is starting to run a little bit hot, but there's a debate on how long that will last. And I know my colleagues will talk a little bit about inflation. And we're seeing some labor shortages due to government unemployment programs, and that might ultimately drive wages higher to incentivize workers back into the workplace. So we continue to have a strong conviction for our high quality secular growth winners. Over the last 6 months, though, we have been adding to some of those cyclical areas of the market, like financials and materials. Given the backdrop of a stronger US economy, accommodative central banks, fiscal stimulus, low interest rates, in the early stages of reopening our economy, we remain pretty sanguine on equity markets, despite equity valuation levels that remain somewhat high. So with that, I am going to hand the baton over to Eric Jusson, who will be talking about fixed income. Eric?
Great, thanks, Ryan. As this chart shows, although interest rates have increased this year, they're still lower than where they were at the beginning of 2020. This rise in rates has resulted in a steeper yield curve as measured by the yield differential between the 2 and the 10-year US Treasury. Historically, a steep yield curve has been associated with improving economic conditions. One of the reasons the yield curve has steepened is due to Fed policy. The Fed has indicated the Fed funds rate will remain highly accommodative at 0% until the economy reaches full employment and achieves 2% inflation. The successful vaccination and outlook for stronger economic growth has also caused longer maturity yields to rise. This rise in rates has resulted in negative bond returns for the first time in many years. Bond returns have depended on what you were invested in and where along the yield curve. Longer maturity US Treasuries were among the worst performers in the first quarter of this year, with the 10-year Treasury returning negative 16%. Turning to the next slide, corporate bond spreads, which is the incremental yield pickup over owning US Treasuries, have continued to decline and are now trading lower than their 5-year average. Fed policy has forced many investors to reach for yield by owning longer maturities or moving down into lower credit quality. 50% of the investment grade rated index is rated BBB. BBB rated credit has outperformed A-rated credit, with AA rated credit the worst performers in the investment grade space through the first quarter of this year. All of our taxable bond strategies are overweight higher credit quality than their benchmarks. With the low level of spreads, we continue to focus on high quality bonds and are not willing to reach for yield given this historically lower level of compensation. On the next slide, the municipal bond market has performed well this year, with returns outpacing the returns of US Treasuries. Spreads continue to decline due to the lower new issue supply compared to last year, and there's increased demand for municipal bonds ahead of potential tax increases. The financial concerns from the pandemic have eased with rounds of stimulus, but also keep in mind, most states had sizable rainy day funds. At the start of 2020, 33 states had rainy day funds exceeding pre-Great Recession levels. Rainy day funds comprise the largest elements of overall state balances. States have to file a balanced budget each year and can pull levers to reduce costs, examples such as layoffs and furloughs. We're still finding value in high quality general obligation and essential service revenue bonds while keeping the municipal bond strategies duration neutral. On the next slide, as Ryan mentioned, we'll talk a little bit about inflation. So market-based measures of inflation have increased with the 10-year break-even rate at 2.5%. This rate is calculated by subtracting the yield on the 10-year TIP, which is your Treasury inflation protected security, from the yield of the 10-year US Treasury. This measure has increased 50 basis points this year. Fed policy, and as Ryan mentioned, the massive amounts of fiscal stimulus have caused concerns that inflation could be greater issue than the Fed's transitory view. Nominal US Treasury rates are not reflecting a buildup in inflationary pressures, which differs from the view of the TIPS market. Although US Treasuries have positive yields, the yields on TIPS are negative, with the 10-year TIP yielding negative basis points today. Overall, we've positioned our bond portfolios to be neutral duration with a focus on high quality bonds that we feel can be held till maturity to mitigate losses as interest rates were to rise. The reasons to own bonds are still valid: steady and predictable income with return of your par value upon maturity. I will now turn it over to David Lynch.
Thank you, Eric. Now I'm going to do some tying it together of what you heard from Ryan and Eric prior. I'm going to start with talking a little more about the overarching economy, both here and abroad. On this first page, you'll see that there's been a pretty massive wealth effect to the benefit of American consumers in that house appreciation and portfolio appreciation have combined to bring household net worth to all-time highs and debt service extremely low and manageable. This combines with pent-up demand and excess savings for a lot of consumers being spring-loaded to re-enter the economy. Now, there are, of course, pockets of distress from the pandemic. I don't mean to dismiss those, but by and large, the overall economy is in pretty good shape. Moving forward to the next page, happy consumers tend to make for happy businesses, consumers being such a large part of GDP. And here's the global picture. You'll see the self-induced lockdown putting a hard red stop to things last year. This is the Global Purchasing Managers Index of economic conditions around the world. Basically a universal synchronized shutdown, but now what we're seeing is widespread recovery with most of the world coming out positively and looking forward to even better days ahead. Now, there are some cautionary tales, such as Brazil down on the lower right, having issues as well as Japan. So the need for vaccine success, as well as being watchful for variants, still poses a risk. But from the current place, things are looking pretty good for businesses. So onward to the next slide. And what could go wrong? We have happy consumer, we have happy businesses. Well, inflation could be a problem and some of the party and some of the rolling euphoria that we're getting on vaccine rollouts. So this is the sort of inverse of the previous page showing economic conditions, this showing inflation. You will see when the lockdown and the global self-induced recession put us into deep freeze, it went to a cool blue deflationary situation. But now as we're resuming activity, you'll see in the far right of this slide, things are starting to pink up again, and in fact turn to a degree of red as inflation numbers come through. You see the US there on the fourth row with our most recent April print, getting us into that red category. Now, thus far, the Fed is saying, don't worry, a lot of this is base effects that can be estimated and predicted based on simple arithmetic on year-over-year basis. But this is also combined with some very real price increases that are in the form of things such as labor shortages, raw material shortages, semiconductor and chip shortages, and inventories being at a low base to begin with. So there are definitely a lot of pressures alongside these base effects. And so it remains to be seen whether this is truly transitory or whether it's something more pernicious that will stay around. To the next page. Price pressures are clearly mounting, but there's been an ability thus far to pass those prices through for the most part. Here you'll see the red line, or excuse me, let's start with the black line. Prices on the way in are rising, but then prices on the way out are also rising. So a bit of lockstep here as things are being passed forward. We'll see how long that can be tolerated, but with a healthy consumer and healthy businesses at the end of the pipeline, up to this point, price increases have been absorbed and we carry on. Onward to next slide. So what does this mean? So the economy is not the market and the market is not the economy. Certainly over long term, they need to reconcile to each other, but in the short term, because the economy is healthy does not necessarily mean it's clear sailing for markets. So as we move now toward markets, you'll see that we're starting from, as Ryan and Eric both alluded to, we're starting from a relatively expensive place. Some may argue that things are fair valued, but you won't find many saying things are cheap, at least on a historical basis at this point in time. And so here you have two measures, the blue line being a measure of the stock market, price earnings ratio. This is the cyclically adjusted PE. Ryan showed a slightly different one, but the same directional picture. And here, higher would be more expensive, all else equal. So stock market's expensive. The dotted line is the bond market, and that proceeding down to the lower right at very low levels. So low being obviously rich and expensive for the bond market. It's really both sides of the traditional equation for a stock bond portfolio are starting from a pretty expensive point. And so how do we manage that? On to the next page, please. So how did we get to this place? Well, we have these unprecedented, very friendly financial conditions. There's low rates and high liquidity combined with optimism about reopenings, et cetera. Things really are about as good as they can get from here. And so there really is only one way to go for the most part, and that would be to get less friendly, to get tighter, potentially more disruptive. But things are very good right now. So if nothing changes, things are great. But our debate and our forward-looking analysis is about what happens next. What is the next likely change that could happen to potentially disrupt what in the current snapshot is a pretty nice setup. So then on to the next page. How does this all add up? Well, we talked a lot about inflation today, and there are deflationary offsets out there, things such as technological improvements and innovation that could increase productivity as a way to help offset some of the wage pressures and labor shortages. So if we'd be willing to pay workers more as long as their productivity keeps up and justifies that. But so we will be facing inflation most in the near term. And so can the Fed stop this overheating? Of course the Fed can, by rapid tightening, rapid tapering, ending of a lot of the stimulus programs. The challenge is, it's not can they do it, it's can they do it without disrupting the markets? And that is something that is not as clear, and that we're in constant debate internally about that. So how do we think that portfolios should be positioned given this set of conditions? Be prepared and diversified for hard landing scenarios. What we think is going to play out is a degree of over and under correcting to find that stable and self-supporting economic balance. So sort of over and undershooting, both in terms of market mood and market valuation, as both legislative and monetary policy tries to adapt and tries to engineer a soft landing, but it's going to be a very difficult act to be completely smooth about the coming quarters and coming years. So for portfolios, we think you should stay liquid, stay nimble, keep some dry powder cash, because there will be intermittent volatility opportunities to add to positions. We'd be neutral equities in that earnings are booming, as Ryan pointed out. They're not always being rewarded with further upside. A lot of the good news is already in the price. And so we have to be thoughtful about what happens next. Add international equities. A lot of our US equities are multinational in their own right, so there's a degree of international exposure there. Client portfolios, both in the custom equity strategies as well as the global asset allocation strategy, have additional direct international exposure. We'd be adding some to that now for the diversification reasons, but also as partly an offset to potential dollar weakness. The dollar is very difficult to predict in the short term, but some of the conditions are setting up for potentially some secular weakening of the dollar, and having more international exposure should help there. Be underweight bonds and be wary of duration specifically, as Eric detailed some of the challenges of US Treasuries. However, there are opportunities to favor selective, high-grade, lower duration credit exposure within that. Moving beyond and diversifying portfolios still further beyond traditional financial assets into things like commodities and hard assets is something that we've been doing for clients in the form of diversified commodity positions, gold positions. We're working for SRI clients to add renewable energy and exposures there. So we're also working on further research for other relative value and opportunity to capture capital inefficiencies with some more unique non-traditional products. So moving to my final page, why are we doing a lot of this? Well, the conditions are setting up that there's prospects for this end of the triple play. And we've been through a decade or more where being structurally overweight US stocks, US bonds, and the US dollar all at the same time has served portfolios very well. It's been there's been a positive self-reinforcing feedback loop. Bonds go lower, stocks go higher, dollar stays strong as a reserve currency. But to the extent that that starts to reverse and unwind, and that positive feedback loop could become a negative feedback loop where bonds weaken, for the inflation outlook worsening, for example, US stocks that have been buoyed by these low rates start to feel pressure and disappointment with rates rising and valuations change. They could come under pressure. The dollar as our reserve currency is always under a degree of scrutiny given our twin deficits and the amount of deficit spending that we've done through our stimulus programs and during COVID here. So it's hard to hold all three of these things up at once. The reason we want to stay diversified around these potential outcomes, though, is it's unclear which leg of the stool would be the one to give way. In a soft landing, maybe each of the three shaves a little bit off and we manage a more soft landing, but there likely will need to be some degree of relief valve. Often the dollar is often cited as potentially the place that relief valve will come from, but that remains to be seen. So there are excesses and distortions in the market comes as these rolling crises have been absorbed by the different programs and different securitizations. We want to stay thoughtful and humble. It does not necessarily mean to sell everything or short the market right now, but to just be humble and realistic about our starting point, and just be vigilant for changing conditions. And that's what the team is hard at work at. Happy to hear more about another significant set of possible changes, our tax policy. And so with that, I'm going to wrap up my section and take more questions later, but pass it to my colleague, David Strawn, for more on the tax and legislative outlook. Thank you.
Thanks, Dave. Appreciate you passing it over to me. I want to take my time here to discuss some proposed state gift and income tax legislation that are in Congress at this time. So to start, if we go to the first slide here, we have the American Families Plan, which was submitted to Congress by President Joe Biden on April 28th, just over 2 weeks ago. A couple of key provisions here is that it calls for the repeal of stepped up basis for capital gains in excess of $1 million. As most people are aware, when someone passes away, the assets that they own are given a new tax basis as of the day of as of the date of death valuation. This bill calls for the repeal of that for those assets in excess of $1 million. Now, for a couple using their full exemptions and the exemption for the sale of a personal residence, they can exempt $2.5 million in their lifetime. There are exceptions, of course, for charitable donations and certain family-owned businesses. There is also the call in this plan to increase the top income tax bracket from 37% to 39.6%, which is the same level as the pre-2017 legislation, which lowered these tax brackets. Moving on to the next plan is for the 99.5% Act, which was introduced to Congress by Senator Bernie Sanders of Vermont on March 25th of this year. A couple of highlighted provisions here that the primarily one being the estate tax exclusion would be reduced from its current 11.7 million per person to 3.5 million per person. There's a portability would be retained, which is the ability to use unused exemption from a spouse. But that 11.7, which obviously is over $23 million, would be reduced to 7. So it's a significant decrease in the estate tax exemption. But more dramatically would be the gift tax exclusion. It would be reduced to $1 million. Right now, the estate gift and generation skipping exemptions are all in lockstep at 11.7 million. So the gift tax exclusion would be reduced to $1 million per person. In addition, there would be an increase in the maximum estate and gift tax rate from the current 40% to 65%. Now, the 65% would apply to estates in excess of $1 billion. I'm not sure how many of our 69 participants are in the $1 billion estate tax bracket, but we'd love to have a conversation with you if you are. There's also continuing on, there's the elimination of valuation discounts. Quite often, people are able to take currently a discount for valuations for lack of control, lack of marketability, other things like that for certain types of assets. Those will all go away. There will be no more allowance for those types of discounts.
David, you went mute. You might correct.
Thank you, Susan. If on the generation skipping tax exemption, it would be capped at 50 years. And if you have a trust that is running for children and grandchildren, 50 years from its inaction, the exemption would go away, and a generation skipping tax event, when that happens, would cause an additional tax to be levied at that time. Sort of an arbitrary amount of 50 years has been proposed in this plan. Moving to the next bill was submitted by Congressman Chris Van Hollen on March 29th, 2021. It's called the STEP Act, Sensible Taxation and Equity Promotion Act. The main provision here is really a change to our overall tax system. It makes it very similar to what some of you may be aware occurs in Canada. Taxes would on unrealized capital gains upon inheritances at death or by gift. There would be, so right now, as we mentioned, there's the step up in basis. Well, the unrealized capital gains would be realized upon an inheritance of the property at death or by gift. So that may cause that gift to have to be liquidated to pay that tax. So that's a major change to what most folks are used to today. There is an exclusion for $1 million of unrealized capital gains. Not sure how that is applied, whether that is proportional, or you can pick and choose those securities for which to cover with the $1 million exemption. And it also, someone can apply $100,000 of that exemption to gifts during lifetime. Taxable estates would receive a deduction for capital gains taxes paid. So if a client passes away and they have unrealized gains that need to be realized at that time, the amount of the tax would be a deduction that would offset any estate taxes due at that time. There's a special rule for irrevocable trusts, which sometimes people put low basis stock into irrevocable trusts and let it sit there and sort of do its thing over generations per se. Property held in a non-grantor trust would be treated as though it was sold every 21 years. So even though it doesn't have to be sold, it would be treated as though it were sold, and a capital gains tax would be paid on that value, of that gain every 21 years. And this would be applicable for all transfers after December 31, 2020. So we would be in this regime at this time if this bill passes. So it is an interesting possibility if this were to pass. So these are three bills that we are keeping our eyes on. That we're not sure what is going to happen here. We have a very tight Senate, 50-50. And right now, there are a small handful of Democratic senators who don't want tax increases to this extent. So we will see if there's the ability to get any of these things through, or maybe there will be some sort of consolation prize here for some sort of bipartisan agreement that gets through and provides some sort of additional taxes here. But we will keep you up to date as we know information comes through. So with that, Susan, I'd like to send it back to you.
Thank you, David. Quick question for you. Do you think there will be a coalition in Congress so that a bipartisan bill can be passed? And if so, when do you anticipate that might happen?
That's a great question, Susan. Like I said, the Congress is pretty tight right now, and I think there's a lot of partisanship about that comes around taxes. So I'm sort of pessimistic that anything will get through. Maybe that's an optimistic thing that nothing gets through. But anyways, I think it's going to be difficult to get something through the Congress the way the Senate is set up right now. But you may see some sort of compromise that maybe a few things get through from these bills. But I don't think lock, stock, and barrel any of these three will get straight through.
Thanks, David. I welcome you to input your questions at the bottom of your screen. You should have a Q&A. Just if you tap on that, you can type in your question. David Lynch, a question for you. How does the end of the triple play slide influence your view of asset allocation?
Sure, happy to address that. I maybe went slightly out of order. The slide prior to that alluded to some of the outcomes that we would recommend in preparation for this potential end of the triple play, or at least softening of the triple play. That would be to add more international in case the dollar is the leg of the stool that weakens. We think that US large cap growth, though under some pressure now, is very quality given its setup and can be held for the long term, in part because of its multinational exposure. So we would add some outright international, but that doesn't mean to forego some of the quality US multinationals that are also held. Diversify further beyond just straight stocks and bonds, US stocks and bonds in that case, to also include things like commodities. Should we have inflation continue to bubble? We think there is some diversification and offset there. I hate to use the word hedge because nothing is a perfect hedge, but certainly an offset. Be patient and know what you own. So be selective. We hope that we've positioned portfolios in quality positions that can be held through the cycle. Some will say that this end of the triple play is how I like to phrase it. Some call it an end to US exceptionalism. It's not necessarily my favorite term, but the notion that all three of these, the stocks, the bonds, and the dollar, can all lead at the same time is what we want to be diversifying away from that in case that is no longer how the investment returns come through. Other aspects, similarly in bonds, know what you own, be comfortable with bonds that can be held through the cycle, through any of the disruptions here. So it's just being more global. Portfolios are already quite global. I think we're going to be leaning on that more going forward than we have in the prior decade.
Thanks, Dave. Request to maybe comment on the mortgage rates and the housing market through 2022. I'll send that over to Eric.
Yes, that's a great question. So typically, for residential mortgages, the mortgage rate, the 30-year mortgage rate, is usually tied to 10-year Treasury rates. So if interest rates were to increase, mortgage rates would start to go up as well. So if rates rise, you would see mortgage rates start to move higher. That being said, the outlook for the housing market, right now, the housing market is incredibly strong. It's more of a supply-demand imbalance. There's a tremendous amount of demand and not as much supply available in the market, which continues to drive prices higher. And that could very well continue into 2022. I think one way to look at it as, this is not similar to the banking crisis that was led by residential mortgages overall, back in 2008, 2009. Underwriting standards are still very, very high. So there's no fake mortgages or, no doc mortgages being created in this environment right now.
Brian, a question for you. Many of us remember Enron and the fact that no one could really figure out what the company was really doing. Does Cambridge Trust have a perspective on cryptocurrencies, and are you investing in the space?
Yeah, it's a very timely question. Interesting, I just read a report this morning saying that the long Bitcoin trade is the most crowded trade in the market today. It has surpassed the long tech trade. So clearly it's garnering a lot of attention. Our approach has really been to take a more cautious wait and see approach. The crypto space and digital currency in general is a growing and evolving area of the market. So clearly, I think we're going to have to keep our finger on the pulse. There's a pretty wide disparity of the goods, the bads, the yeses, the nos, and it sort of ranges the gamut of different types of investors. But clearly, we've seen a pickup in institutional attraction. Some prominent hedge funds, asset managers, and pension funds have taken positions in there. And even some sort of more traditional, common stocks or equities like Tesla is accepting forms of cryptos. PayPal allows cryptos to be stored and exchanged on its platform. So I'm not going to bite on the Enron comparison, but it's a space that's very, very interesting. It's a space that we need to stay on top of. I'd make a couple of other potential notes that, volatility has been pretty extreme. It's been more than double the NASDAQ and the S&P 500. And just this year, Bitcoin has gone from 30,000 at the beginning of the year to 63,000, and now it's down in the low 40,000. So volatility, within client portfolios is something we want to be very cognizant of. So it's an interesting space. It's a space that we need to be more in tune with. The underlying blockchain technology that most of the cryptos are built on is very viable, but it's unsure. We're unsure of the next sort of big thing in terms of whether Bitcoin or Ethereum or Litecoin, or if you're Mark Cuban, maybe it's Dogecoin. I don't know, but for now, we're going to take a little bit of a cautious and wait and see approach.
Great, thank you. For all of the panelists, considering the totality of the programs with the potential of $5 trillion and another $4 trillion in fiscal support, what implications does fiscal expansion have, and is there a price to be paid down the road?
All right, Susan, I believe you're directing that toward me. We talked a little bit about some of the potential risk in that if all of the stimulus and the additional fiscal and legislative spending combined with what is a recovered and expanding private sector economy, if both of those are competing for resources, sort of crowding with each other, what could be a good scenario could become an overheated scenario, which creates this potential negative feedback loop of higher rates and inflation, which is fine if it is moderate and controlled. In fact, stocks may do just fine if it's a moderated and gradual inflation. It's if things get de-anchored and a bit out of control that we could have some upset, be it in bond stocks or the dollar in terms of a kind of crisis of confidence, if you will. So that would be where things would go if they went a bridge too far. And some of this debt financing and money printing to fund these programs, to the extent that it is unaddressed deficit spending, at some point that those coffers need to be sort of refilled, and these programs need to be paid for in one way or another. Could it be through growth? That would be ideal, but there may be taxation or other things that create a vulnerability. And so that would be, to quote your question, some of the potential price that might have to be paid to reconcile and balance accounts through what's been going on over the last couple of years and what is kind of under current proposals.
Thanks, Dave. Eric, if inflation does rear its head to a great degree, do you see it as transitory or entrenched, and what effect will it have on interest rates?
That's a great question. Right now, the view in the market, or at least the Fed is orchestrating that it will be transitory. So that's why I think you haven't seen Treasury rates move significantly higher, even though we've had, stronger evidence of, consumer price increases with the CPI report of last week. So if it is transitory, probably see a moderate rise in interest rates. But if it turns out to be more overheated than the Fed's view, you could see rates move up quite significantly in a quite a quick fashion. So I think the jury is still out as to how transitory or how these effects will be, especially when we'll get more data in the next couple of months as more economic reports come out. But it's something we continue to watch, and that's one of the main reasons why we have our portfolios all positioned for a neutral duration or neutral interest rate exposure. I don't know if any of my other panelists have any views on the inflation outlook.
I could add just a couple of comments. Maybe we should just talk about what if this inflation does prove transitory and we end up with kind of deflationary offsets and a settling there. The side of that coin to watch for is that if we don't get inflation, it could signal that our potential GDP is less than we think it is, which could be a winding down of what we've had a lot of pulling forward of demand. We have demographic shifts going on, that there may not be as much juice left in the economy moving out the out years. So hopefully inflation can be managed and does come back down, but it's not necessarily free lunch if it does, because it could mean that there's some other complications such as these demographic or GDP potential kind of issues to be managed.
Great. Any other questions that we can address for you today? David Strawn, I had one more for you. The Van Hollen bill you mentioned appears to position the U.S. similarly to Canada. What kind of an effect will that have on our economy?
Well, it's hard to say, Susan. There's a lot of different studies that show positives and negatives to any of these tax plans. I think that the way the Canadian system works for them right now. This is a major restructuring of our tax program. We're adding a new tax system to an existing tax system. So that would be very interesting. One of the things that makes it very difficult to plan for is the fact that some of these are date-specific type taxes, meaning that you pay a tax at a specific time, and whether or not you can hold on to your assets through the process of paying that tax is a real challenge. So there's a lot to come. It's very difficult to say, but it'll be interesting to follow as we go forward and see what does pass through our Congress.
I don't see any additional questions. I do want to thank you again for joining us this afternoon. We hope you found the information helpful, and we welcome your suggestions for future webinars. A special thanks to Michelle and Allison, who are behind the scenes making the technology work for all of the panelists. We do hope to see you for our Q3 webinar. You'll receive information about that, and reach out to your relationship manager, portfolio manager, if you have any further questions. Thanks once again.